Hi, my name is Kris. I'm an advisor at Eckman Wealth Management, and today I'm going to be really talking to you about what is one of those first conversations I have when I'm speaking with clients, and that's about allocating funds, right? You get the paycheck, the money comes in. I think probably one of the biggest mistakes and one of the best starting points is this because people get this paycheck, especially I find people in maybe their, 20s, they're starting to get their paychecks going up, early 30s, they're starting to see savings go up, but they don't really have an idea of where's that money going, right? Like what's going in the bank account, the savings account, or the checking account, the savings account, Roth IRA, retirement plan, the investment account. One of those first conversations I have is breaking down, where that money goes. And for every person, it's different. So this isn't going to be, hey, this is exactly what you should do. Of course, reach out. We have links down below if you want to reach out and have kind of a one-on-one. Also in the comment section, we like to be active in there too. But really just a template. So as you're kind of evaluating what you're doing with your money as your paycheck comes in, however it comes in, bi-weekly, monthly, bi-monthly, twice a month. You'll have a good sense of it. And I'm wearing a Diamondback shirt because I'm a Diamondback fan, and they are actually in a playoff race, which is very rare for the Arizona Diamondbacks. So really just want to start by saying there's not a good or bad. That's like the first thing I think I get really frustrated about is people say like, I'm doing a really good job. I'm putting like this much into my 401k, or I'm doing a terrible job. Like all my money is sitting in, this robo account. There's not a good or bad. It's really just starting from, and this is where everything should start from, including in investing, is the purpose and goal, right? Like what is the point of this money? What is the goal of this money? And if you go into it with that framework and you approach the dollars with that framework, it makes everything a lot easier. And it also helps in terms of, if you're investing money, it helps with that volatility, right? The ups and downs. If you go into it with a framework of, this is money I'm setting aside for 20 years from now. So the purpose of this is not August or September of 2023. It's 2042 when I'm starting to think about retirement. So I think the first thing is the thing that really, I don't say frustrates me, but it does. It frustrates me when I sit down and I talk to people. So I think from there, it's just easy to break down the pots, right? You get the paycheck, probably goes into the checking account. There's pros and cons of everything. So if your money's in a bank account, the biggest pro of the bank account is it's easy to access, it's stable, and you can pay your bills with it, right? I can't pay my bills with a share of stock, right? Like I can't go to Starbucks and be like, here's 0.02 Apple stock, thanks for my venti, whatever is in season right now. You can't do that. So the bank account is great because it's accessible. You can pay bills with it, and it's stable. You're not gonna, get a credit card bill in 2 weeks and your bank account fell 20% because of a bad earnings report, right? And that's the perk of the bank account. Con of the bank account is, it's low growth when you compare it on average to other assets that are out there. There is more potential in savings accounts. Savings rates are going up. If your bank isn't taking care of you when it comes to that interest rate, probably a good time right now to look around at other savings accounts and see what's out there. Bank account support, need it for checks. Outside of that, once you say, hey, this is kind of that pot that I have for those monthly expenses, then you look outside of that. So I think the first place you look to if you have a retirement plan, really want to start with what's that employer match? Can I handle that? Do I have enough money coming in where I can take a little bit of my paycheck, put it towards my retirement plan, still cover my bills, and there's an employer match, right? People call it free money. I sort of disagree with that because, 3% of your paycheck is probably a really amazing night at Chili's. So, right, you're putting money aside that you can't access without penalty most likely until you're 60. And that's money you could really go crazy on chicken crispers with. So I think it's, I don't like to say free money, but it's certainly something that if you have that ability to do it, taking advantage of the match is a great place to start when you get that paycheck. Then outside of that, it's starting to look at what are the goals, right? I say start with the match, right? So it's not, hey, put everything in the 401k, put everything in the 403b, 457, TSP. Start with the match. Then from there, you go back to what are my goals if there's extra savings outside of that. Biggest mistake I see from a lot of young people, and it could not be more important, is I get these young people, and maybe they're, I call them young people, 29, 30, no, I'm turning 31 soon. So let's say 31 years old, and they feel really good about themselves, and they've got money in a checking account, and then they've really been maxing out the 401k. And maybe that's great. The problem is they'll come to me and they say they want to buy a house. And if your funds have been prioritized in the 401k, it's not matching that goal of buying that house. And right now, with interest rates where they are, you know, getting approved for that mortgage, having that down payment, being competitive in an environment where home inventory is really low is really important. So if you haven't made that a priority, it's going to be hard to attain that goal of buying the house right now. So start with the employer match. Then you go back to the goal. If the goal is a home in the next, 5, 6, 7, 8, 9, 10 years, I'd say 3 or more years, really you should be looking at, okay, I need to put some money aside for that goal. Two ways to break that down. Investment account, my opinion is if it's looking 3 or more years out, I would say look at an investment account. Obviously, from there, talk about investments, index funds, think those types of things. Keep it simple. But I look, maybe towards the investment account. For me, if it's within 3 years, then I'm looking at things right now like CDs, the Treasury market, high yield savings accounts. Right? To me, less than 3 years, you're talking about too short a time period where I want to risk that in the market. The market can be down, for multiple years. Look at 2000 to 2002, that .com bubble was pretty painful. You don't want to get caught in one of those situations. So to me, look at your time horizon. What's that big purchase you're looking at? Make sure you're allocating some dollars for that. If you've allocated some dollars from that, worked on that budget, then from there, I move to most of the time a Roth IRA, right? Can I do something with a Roth IRA? It's great to have two pots, a pre-tax retirement plan and a Roth IRA working at the same time. And I won't get too into a Roth IRA. There's differences with the tax savings. I basically sum it as your 401k if you do it in a pre-tax pot. I know retirement plans have Roth, but I would say use the retirement plan for the pre-tax purpose. Near-term tax savings. It's going to lower your tax bill that year. The Roth doesn't lower your tax bill that year, offers long-term benefits in terms of retirement, also offers some flexibility in some of the features it has, accessing contributions, also some flexibility and features for that home purchase. There's some special rules in there I won't get into, but the theme I'm thinking of is basically breaking it down to refresh. Money comes in, goes to the bank account. Make sure you have that money allocated for your bills. After that, matching the retirement plan. If there's a match, try and take advantage of that. After that, looking at the goals, right? If there's a goal where you need funds, like a home goal that's coming up, a car goal potentially, look towards those pots where you can draw money from. If it's more than 3 years, say look to invest in the market. Below 3 years, high yield savings account, CDs, treasuries. After that, if you've kind of maxed those out, instead of going back to the retirement plan, I'm a big believer in looking at the Roth IRA. Every situation is different. Certainly, if you're in a high tax state, I am sitting in New York City right now. There are some benefits. If you look at the pre-tax savings and you prioritize that maybe over a Roth because you're saying New York and New York City have that higher state and local tax, I'm wearing the Diamondback shirt. I'd certainly love to retire in Arizona. Big difference in terms of taxes. If I get the tax savings in New York, retire and take that money out later when I'm old. The Diamondbacks still haven't won a World Series since 2001, but at least I'm enjoying, paying those taxes at a lower rate because of, I got the savings in New York. I retired in Scottsdale, Arizona. So I think that's sort of like the basic breakdown. If you get that paycheck, most importantly, go back to purpose. This is very broad. Every person is totally different, but just trying to give a framework of your pay comes in, something to think about, a basic framework to go off of. If you disagree with me, you can write in the comments. I love to learn and kind of share ideas. There is no perfect answer when it comes to money. Every situation is different, and people have a lot of different ways to look and evaluate money. So certainly I like to learn from what other people are doing and certainly give my own opinion within that. But I'd go back, if there's anything you take from this video, anything at all, I think the first thing I'd say is just make sure as that money comes in, you have a purpose assigned to it. Think about your pots, the Roth, the basic investment account, your time, think of it as jars. Think of it as like putting money into the different jars. Make sure you're not just having money accumulate in a spot that's not meeting that goal, right? If the bank account gets really bloated, but you're not trying to do anything in the next couple of years, right? It's just not matching the goal. It's not matching the purpose. And I think that's where a lot of financial frustration comes in is, I wanted to buy a house in a year. I put it in the market. 2022 stunk. Now I'm mad that the market went down, right? If you approach that in the correct lens, understanding what the goal is, you can kind of match that pot. You avoid those frustrations. Same with if you're underinvested, you're keeping too much money in the bank account, and you're saying 10 years from now, you sit down with your friend, he's got all this money in a 401k, right? It's all about purpose and goals. Every single person is different. Everybody has a different family situation. Talking about home buying, young people, it's really important though, more than anything, think of your purpose, think of your goal, make sure the way the money's coming in, the way you're allocating it in the different pots is matching your goal. Like I said, questions, schedule a meeting. Our Calendly's below. Leave something in the comments. Happy to share ideas. Like I said, I love learning and listening and reading what people have to say on this. So once again, Kris, thanks for the time, and be sure to subscribe and stay tuned for future videos.